You are watching a company spend more electricity answering a single question than your home will use in an entire year. Not a city, not a factory. One question, one answer, one model. In the next 9 minutes, you will discover what the press releases never announced. The funding rounds made headlines. The collapses did not. Between 2022 and 2024, more than 3,000 AI startups shut down globally, burning through a combined estimated $900 billion in venture capital without ever reaching profitability. This is not a story about technology failing. This is a story about money meeting physics, and physics winning. To understand what happened, you need to go back to the moment everyone believed the math would eventually work out. The rise began with a genuine and extraordinary breakthrough. In 2020 and 2021, large language models demonstrated capabilities that legitimate researchers described as unexpected. Machines could write, reason, summarize, and generate. Venture capital, which had been searching for its next category-defining wave since the smartphone, found what it was looking for. Funds poured in. Valuations climbed. Startups with 18 months of runway and no commercial product were raising hundreds of millions of dollars on the promise that compute costs would fall, demand would scale, and revenue would follow. The logic was not irrational on its surface. Every major technology curve, semiconductors, cloud storage, bandwidth, had followed a similar arc. Costs fell, markets expanded. Early losses became historic profits. Investors who had watched Amazon lose money for years and emerge dominant applied that same framework here. What they may not have fully weighed was that AI infrastructure costs were not falling. They were accelerating upward. Training a single large language model in 2023 cost between $50 million and $100 million. That figure was not stable. According to compute scaling laws that researchers openly discussed in published papers, that cost doubled approximately every 18 months. You were not buying into a depreciating infrastructure. You were buying into an infrastructure that demanded more capital every year simply to remain competitive. $900 billion in venture capital burned without reaching profitability, and then the hardware crisis arrived. NVIDIA's GPU backlog in 2023 stretched to 52 weeks. A startup that needed compute to train or run its models could not simply place an order and wait. Waiting meant falling behind competitors who had secured supply earlier. So startups turned to secondary markets, where GPUs were available at premiums of 300% above list price. Companies that had raised $50 million were spending it on hardware at 3 times the intended cost, before writing a single line of product code. This is where the structural fragility became visible to anyone examining the numbers carefully. Some analysts and observers began raising questions publicly about whether the unit economics of AI-native businesses could ever close. Revenue projections assumed that compute costs would normalize. But normalization required either a hardware breakthrough or a fundamental rethinking of how these models were built. Neither had arrived. OpenAI, the most prominent name in the sector, reported an estimated $5 billion operating loss in 2024, despite generating approximately $3.7 billion in revenue that same year. To be precise, this is based on figures reported across multiple financial publications and has not been independently audited in a public filing, as OpenAI remains a private company. What those numbers suggest, according to analysts who reviewed them, is that even at meaningful scale, the cost structure of frontier AI may currently consume revenue faster than revenue can grow. The cracks were visible. The question was whether anyone in the room wanted to be the one to say so out loud. Then, in January 2025, a Chinese AI laboratory called DeepSeek released a model that independent researchers and technologists assessed as competitive with GPT-4, at approximately 3% of the training cost. In a single trading day, $600 billion in United States technology market value was erased. Not over a quarter, not over a year. One trading day. What DeepSeek demonstrated, regardless of any geopolitical interpretation, was a technical possibility that many inside the American AI industry had treated as distant. That the expensive path was not the only path. If comparable results could be achieved at a fraction of the cost, The entire capital thesis that justified $900 billion of investment required immediate re-examination. $600 billion in US tech market value erased in a single trading day. The collapse for thousands of startups did not look like a dramatic implosion. It looked like a calendar. Runway ran out. The next funding round did not close. Compute bills arrived. Payroll was missed. Teams of 30, 50, 200 people received notices in Slack messages or brief all-hands calls that the company was winding down. According to data tracked by research firms monitoring startup activity, the majority of shutdowns between 2022 and 2024 occurred quietly, without press coverage, without postmortems, without explanation. The aftermath landed on people, engineers who had left stable positions at established companies for equity that was now worthless, founders who had spent 2 years building something that the market's infrastructure could not yet support, institutional investors explaining to their own limited partners, pension funds, university endowments, charitable foundations, why positions marked at extraordinary valuations were now written to zero. This content is offered as educational analysis of publicly available information. The figures cited here come from published research, financial reporting, and documented market events. They describe structural patterns, not conclusions about individual companies or their futures. The lesson is not that artificial intelligence will fail. It is that the financial architecture surrounding any powerful and expensive technology can fail independently of whether the technology itself works. Compute costs are real. Hardware supply constraints are real. The gap between what a model can do and what a business can charge for it doing that thing, that gap is real and it does not close automatically. The electricity is still running. The servers are still answering. The question is who is paying for them and whether the math ever resolves in their favor. Here is the question I keep coming back to. If you had seen these numbers in 2022, the compute costs, the hardware premiums, the scaling laws, would you have invested anyway because the technology was real? Or would the economics have stopped you? Tell me in the comments, because I think your answer says something important about how we evaluate risk when we are standing inside a moment that feels historic.